Today, we will talk about fixed capital. Fixed capital includes the assets and capital investments, such as property, plant, and equipment, that are needed to start up and conduct business, even at a minimal stage. These assets are considered fixed in that they are not consumed or destroyed during the actual production of a good or service but have a reusable value. Fixed capital investments are typically depreciated on the company's accounting statements over a long period of time, up to 20 years or more. The concept of fixed capital was introduced in the 18th century by the political economist David Ricardo. This was opposed to Ricardo's idea of circulating capital, such as raw materials, operating expenses, and labor. Fixed capital is the portion of a business's total capital outlay invested in physical assets such as factories, vehicles, and machinery that stay in the business almost permanently, or, more technically, for more than one accounting period. The amount of fixed capital needed to set up a business is quite particular to each situation, especially from industry to industry. Some lines of business require a large number of fixed capital assets, while others, such as service-based industries, have more limited fixed capital needs. Procuring fixed capital can be a lengthy process and increase the risk of financial losses associated with low production if a company does not have redundancy built in. Fixed capital investments typically don't depreciate in an even way that is shown on income statements. Some devalue quite quickly, while others have nearly infinite usable lives. The depreciation method allows investors to see a rough estimate of how much value fixed capital investments are contributing to the current performance of the company. Fixed capital assets are not considered very liquid in nature due to the limited market for certain items, high prices involved, and the lengthy time it takes to sell a fixed asset. This contrasts with variable capital, the cost and level of which change over time and with the scale of a company's output. Here are 4 key takeaways. 1. Fixed capital consists of assets that are not consumed or destroyed in the production of a good or service and can be used multiple times. 2. Property, plant, and equipment are standard fixed capital items. 3. Fixed capital assets are usually illiquid items and are depreciated over time. 4. The opposite of fixed capital is variable capital. Hope this would help. Thanks for watching.